thanks everybody for being here. We will get started. I like to try to keep our timelines as tight as possible. I know it's a busy time for everybody, and I am really grateful to have our guest speaker tonight. Before I introduce him, as always, I always just like to take a moment and thank you guys for being here, but also remind you why we do these things at WealthShare. We are investors just like you guys, and we gain a lot of knowledge and experience and expertise along the way. And we know a lot of our WealthShare investors are also active investors. And so we like to share our trusted partners that we trust in the industry, those contacts, and as well as their expertise. So tonight, I have Nadeem here from GreenBirch Capital, who we've known for a couple of years now, I think, and is absolutely killing it in the space. And what I love about their group is they are very quick to respond, easy to work with, and also will, take challenging files, right? Like there's a lot of groups and brokers out there that won't necessarily do that. So I really, really appreciate you being here this evening and sharing your expertise with us.
It's my pleasure. Thanks for having me, Natasha. I really appreciate it. It's always great to work with your group as well.
Yeah, thanks so much. So kind of the plan for this evening, the intent was to talk about the MLI Select program, maybe just some key differences from the residential and commercial space I think will easily intertwine with that. As we know, a lot of our investors are residential investors, potentially even already investing in the multifamily space, but the CMHC MLI program, has been a hot topic for a couple of years and it's always changing. So I think that's the plan for this evening. And then after that, I will share a little bit more about WealthShare and what we have going on, and then we'll try to wrap as close to the top of the hour as possible.
So thanks again for having me. It's a pleasure to be here. Just a quick background. I'm the president and founder of GreenBirch Capital. We're a commercial mortgage brokerage that's active across the country. Key there being commercial, and that's typically 5 or more units on the multifamily side, and then retail, office, industrial, seniors, hotels, mobile home park, and the whole rest of the gamut. In terms of experience, we've combined experience of actually close to $10 billion now in combined mortgage volume, with over 50 years of combined experience in this space. And we're actually close to 200 MLI Select approvals since the program launched. Yeah, through almost 3 years ago now. So it's been fun. We've done lots of files. I've been hands-on with virtually all of them, so it's been a great experience. And as Natasha, you were alluding to earlier, our transactions range from working with first-time investors, which actually is an area that's close to my heart and how I started my career working with those folks, to some pretty high-profile deals as well. So we cover a broad range. So the MLI Select program as a whole, what I'll say about it is it goes towards, you can use it for construction of multifamily housing, purchase of multifamily. Same with refinance. You can also use it for conversion of non-residential buildings to residential. So for example, in the office space, in the office market in Calgary, as an example, it's a really popular product, and there's some grants around converting office buildings to multifamily properties. And so that's something the CMHC program does allow for facilitation of. And there is also a program that allows for improvements or renovations to multifamily properties as well. It's not as well known, but we have done it a few times, and I think it's a little hidden gem, if you ask me. So, in terms of the MLI Select program, maybe I'll pause here for a second, and just for the viewers here, I'll say the MLI Select program, CMHC is essentially providing insurance for mortgages. So they're not actually, for this program, lending the money. They're working like an insurance company. The same way you have car insurance and home insurance. They're providing insurance on the mortgage, and the losses are if there's a default on the mortgage. So that's what CMHC is providing here. And then that in turn allows lenders to provide really favorable interest rates because the risk is much lower. And they're also able to provide these higher amortizations that you may have heard about, 50-year amortizations and 95% leverage. That's how they're able to do it. So that's sort of how CMHC's MLI Select program works. It's an insurance product. And for many decades, they've been providing insurance for multifamily housing. And in the past, and the program that still exists as well is what's called the standard CMHC program for multifamily, and it provides up to 85% leverage and up to 40-year amortizations. Now, just under 3 years ago, they launched the MLI Select program, and the intention there was to encourage the more multifamily product to be built and to be transacted, and to make it easier to transact as well. And for that, that's where the increased leverage from 85% to 95%, amortizations from 40 years to 50 years, and they also reduced the premiums as well.
Yeah.
But in return for those really nice benefits, they wanted in return a few social outcomes, what they call social impacts or social outcomes. And there's really three of them that they focused on. One is affordability, which is the way they've defined it for this program is the number of units in a project or in a property that are at 30% of the local median renter income. And I can pull some stats up later if anyone wants to dive deeper in terms of what it is for different municipalities. And so that's what's deemed as affordable. And what's actually really nice about Alberta as an example, where I know WealthShare Natasha is that affordability is generally quite easy to hit. When we do business across the country, and in BC and Ontario, for example, energy efficiency has been much more popular. And then accessibility is sort of the third piece, and it's not as big of an impact as affordability or energy efficiency. Frankly, it goes sort of in that order. Affordability gives you the most impact and the most benefits, then energy, and then accessibility. So accessibility is sort of like that sort of smaller piece that helps you get from one threshold of benefits to the next. And I'll get into sort of what that means. But just high level, energy efficiency is the reduction in energy consumption and greenhouse gas emissions. And if it's a new construction project, that means better energy efficiency in greenhouse gas emissions compared to the national building code. And if you're buying a building, then it means improving the greenhouse gas emissions and energy efficiency from what was there before. Accessibility is similar, and it's really the proportion of units that are meeting accessibility standards. And just for the record, it doesn't just mean the building has an elevator. There's much more to it. I've had people tell me, "Hey, my building has an elevator. Do I get accessibility points?" And there's more to it. There's like how wide the hallways are, what are the ramp access? Can you get into the bathtubs? There's a whole bunch more to it. So those are the social outcomes that they want in return for this program. And there's sort of three big thresholds, or what I would call tiers, of affordability of points to qualify for different level of benefits in the program. So the 3-point levels are 50 points, 70 points, and 100 points. And for an existing property, for affordability, that would mean anywhere from 40% to 60% to 80% of the units being designated affordable. And one thing I should say is it's not just enough for the units to be designated affordable on day one, but the allowable increase on those units, regardless of if a tenant moves in or moves out, or if the same tenant's there, is in provinces that have rent control, it's whatever that rent control is. Even if a tenant moves out, that you still can only increase by rent control amount. And if it's a unit in a province that doesn't have rent control, like Alberta, then it's restricted to what the consumer price index states for affordability in that province, for what's called rented accommodation. What's really interesting in Alberta, as an example, is that the number, like we just looked at a few weeks ago, and the number, if you had purchased a property or constructed a property a year ago, and you're now increasing the units a year later, the rents on them, in Alberta, that number is 11%. So you could actually increase your affordable units by 11%, because that's what inflation is. Now, keep in mind the actual increase in Alberta in many places has been more than 11% in the last year, but it's actually a pretty healthy number, though generally that tends to come down closer to normal inflation numbers, and that's usually in the low single digits. But something interesting to keep in mind. What's nice here too, what I'll point out is that for new construction, if you're either building a newly constructed property or if you're buying a newly built property, I know Natasha, you have some familiarity with this. If you're buying or building a newly constructed property, the number of units that need to be designated affordable to get the same level of benefits is much lower, and that's to encourage the construction of new multifamily buildings being built. So that's a pretty nice benefit, nice perk, and really orients people towards that outcome. A couple of things I'll mention: minimum commitment of 10 years for these units to be affordable, though you can designate 20 years and get an additional 30 points. I talked about how rents can increase. There's also, I'll say this, there's also no restriction on the potential suite types you can use. So often people will use, for example, in the case where you might have a product that's townhouses with basement suites. You can designate those small one-bedroom basement suites as the affordable units, and they tend to meet the thresholds more easily. Unfortunately, it's just resulted in some unintended consequences. I've had more than one developer come to me and say, we're looking at building a whole apartment building full of studio apartments because it'll qualify nicely for the MLI Select program. And that is sort of what it is in terms of the way the program is currently structured. And then you got to look at sort of the rent per square foot, and you got to actually designate the lowest cost units for that unit type as affordable. You can't sort of pick the highest units that are below the threshold. So a few little nuances there, but that's sort of how affordability works. And then for energy efficiency, that's where you have 20, 30, and 50 points. So if you remember affordability, the most points you can get was 100. Energy efficiency used to be a maximum 100 points, and it was recently changed. To see, Natasha was alluding to, CMHC was making some changes, and I expect there's more changes to come. I'll get into that in a little bit, but at the moment, the maximum points you can get for energy efficiency is 50 points. And remember, you need 50 points to qualify. So if you're getting these lower point thresholds, you got to tag on some affordability or accessibility to actually qualify. Now, for existing properties, it means reducing the energy efficiency, improving the energy efficiency by 15, 25 to 40% for these three different point levels. And for new construction, it's 20, 25, and 40% better than the national building code. Now, a couple of things I'll give you a sneak peek on what I was going to talk about a bit later, but in terms of affordability, the median renter incomes that CMHC is using is actually from about just over 4 years ago. So there's a lot of discussion in the industry about how CMHC is looking to update those thresholds to be more current median incomes, which means it's going to become a little bit easier to qualify for affordability because those thresholds will go up because incomes have gone up in the last 4 or 5 years. On the other hand, with new construction, you can see here the building codes that CMHC is using is 2017 and 2015, and there's been newer building codes since then. And every time there's a new building code, the energy efficiency standards of that new building code tend to be better. And so what's likely to happen is that CMHC is likely going to reference newer building codes, and then you have to be better than a more efficient version. And so it's going to be harder to hit some of these new construction energy efficiency points. So affordability will get easier, energy efficiency will get harder. Again, Alberta has an advantage with affordability. It's going to be tougher in Ontario and BC and some of the other provinces. So it's a value based on a percentage decrease in energy consumption over the past performance. Energy changes and commitments must be valued and confirmed by an energy auditor. So you actually have to use an energy auditor who would project what certain changes you make would result in terms of energy efficiency. And then if you're completing the changes with your own funds, it can be changes you've made in the previous 12 months prior to the financing or in the following 2 years. So CMHC will actually give you the money and then ask that you get the changes done in 2 years if you haven't already. So they do give you the benefit of the doubt. You do have some time to make those changes. And then finally, accessibility. And so like I had mentioned, accessibility has a fewer level of points, 20 or 30 points. 20 points if you have 15% of the units being considered accessible according to this building code standard, CSA standard that's listed there. Or you can have 15% of the units being designated as universal design. And universal design means that the space is adaptable for different ages and different types of use. So, for younger use, and then can you adjust the unit so that it's usable for a different age group or as someone ages in place, as an example. And then the alternative is Rick Hansen Foundation Accessibility Certification, which I generally recommend people look at because that's a third party that'll give you a score or a ranking based on what you have, and they'll really work with you to help get you the certain level of accessibility, if you will. So there's three ways to get 20 points here, and there's also 3 ways to get 30, and it's just similar. There's a universal design component here that's stronger, and the Rick Hansen Foundation certification is really just a higher score that you would need to get. So that's how accessibility works there. And then in terms of the point matrix, so like I was alluding to earlier, the standard CMHC program that's still there, 85% leverage, a 1.3 debt service coverage ratio, which means that's the ratio of the income from your property compared to your mortgage payment. So you need to have $130 of income for every $100 of mortgage payment. That's what your 1.3 DCR really means. Amortization 40 years, and the premiums start at about 5.35%, which get added to your mortgage, similar to homeowner loans. But they go up from there if you increase your amortization further. Now, MLI Select, as I was alluding to, there's lower premiums, and the more points you get, the lower the premiums are. 3.8 for 50 points, 3.3 and 2.55. So in addition to that, the leverage starts to go up as well. The amortization starts to go up. And really importantly, the debt service ratio is only 1.1, which makes it easier to qualify, which means you can typically get more loan amount because of it, because you only need $110 of income for every $100 of mortgage payment for that 1.1 DCR. So that's what makes this program so attractive compared to what was previously there. And then for new construction, CMHC was also providing higher leverage for that. The premiums tend to be higher. And in new construction, all point levels can give you up to 95% loan to cost. But don't forget, the 95% loan to cost is not guaranteed. It always is important to look at your debt service coverage ratios. And if you hit a 1.1 debt service coverage ratio and you're at 80 or 85% loan to cost or purchase price, that's where your leverage stops. So it's not a guarantee to get that max leverage. Both the debt service coverage ratio has to work as well as your leverage ratio. And again, you can see the more points you get, the lower the premiums. But the construction premiums are higher than the existing property premiums because there's more risk for it. So that's kind of how the point matrix works. This is really important. I want to spend some time here because people often want to know, how does it work to qualify for this program? If I'm looking to buy something, how do I qualify? And it's really important to note as well, and Natasha and I were chatting before this call, is to talk about the difference between residential mortgage qualification and commercial mortgage qualification, because there's some, important difference here. So the key here in terms of qualification on the commercial side with CMHC and multifamily mortgages in general is that your net worth is far more important than your personal income. In fact, a lot of investors that do a lot of business here don't necessarily declare a lot of personal income, especially if they're self-employed or running or owning or investing in their own buildings. And so net worth is really what matters. And that's like the total of all the assets you own, less all the liabilities. So assets can include cash, bonds, mutual funds, stocks, the cash value of life insurance, not the payout value. And then, of course, equity in real estate, which is generally the vast majority of people's net worths that we see. And typically, CMHC wants to see 25 to 50% of the loan amount in net worth. The technical requirement from CMHC is 25% 25% net worth to loan amount. However, when it comes to construction, as an example, that's where CMHC wants to see more generally, and the rule of thumb there is 50% net worth to loan amount. The other thing that I'll say is that the net worth calculation, CMHC often will discount some value. So they're going to look at if you have any RSPs or anything that's registered, they're going to discount that by 50%, because if you have to cash it out, you're going to have to pay some taxes and some penalties on that. They're going to discount all the vehicles you own to zero because vehicles tend to depreciate. They don't really want to be in the business of valuing vehicles. And then in terms of the real estate you own as well, they have to substantiate the value. So if you say I have a few properties worth X, then they want to substantiate it. One easy way to do that is property tax assessed value, but we all know that they often come out lower. And so sometimes you need to get appraisals to verify that. So that's why I like to say rule of thumb, net worth to loan amount, 25 to 50%, because 25% is a technical requirement for a existing property, but remember that those get discounted by CMHC. So that's kind of the typical ratio. Income plays a very minor role. It's sort of more of a qualitative. If someone has a really high or really strong income and someone's net worth is kind of like borderline qualifying, just barely qualifying, the income sort of provides that comfort, but in and of itself is not really relevant. The other piece is liquidity. So this means it's not just enough to have net worth, but really the question is how much of that net worth is liquid. So if all your net worth, as an example, is tied up in a bunch of real estate investments, potentially a bunch of land or some properties that are harder or take longer to liquidate, then it's more challenging for CMHC to get comfort. And this is especially true for construction projects. So if you have a construction loan, this liquidity is even more important, and CMHC is looking for people to have liquidity of 10 to 15% of the construction costs of the project included within the net worth. So you have a net worth of 25 to 50% loan amount, and then within that net worth, they want to see that you have enough liquidity to fund any cost overruns, or if you have enough liquidity to fund any shortfalls in cash flow for an existing building. So it's becoming more and more important. Now the credit score here, and this is kind of in priority order. So the credit score here is third in line. It's not really that important unless you have a really bad credit score or a previous bankruptcy or something really poor. I had some clients that were approved for CMHC mortgage and they had credit scores in the low 600s. What was important there was that the story and what the background was to that. I had someone that had a credit score in the high 500s, but he was a victim of credit fraud, and there was an issue with that. And it's really about telling the story and the whole picture rather than just a score in isolation. And again, if someone has an exceptional credit score, it's more of a qualitative if the other pieces are kind of on the line. And then finally, experience. So experience I've put forth here because it's if you don't have the experience, you can hire or partner with someone, or you can, pardon for this call, you can invest with someone that has that experience as well. So that's where the experience comes in. It's especially true for construction projects, but even for existing properties, if you don't have the experience, CMHC really likes to see people partnering with people that have the experience. You can also meet some of that through experienced property managers, and for construction, you can meet that through working with an experienced builder. So really important here. I wanted to make sure we spend some time, and maybe I should say as well, if you have questions, note them down, and then I'm sure we'll have some time for Q&A as well, Natasha, if we can squeeze in a few minutes for that. Well, maybe perhaps I should pause there. I mean, next I have some a case study perhaps we can go through, but perhaps I'd pause here and see if people have questions or anything that people want to ask.
Well, and just if there is questions, throw them in. But kind of a couple things I noted down was these incentives and these programs, there are designed to obviously incentivize construction and to help solve the housing crisis we are having in this country. But your example about, say, building an entire building of studios, that's concerning when I put my other hat on as a realtor and as a Calgarian who has managed properties in this, province for decades, because there could be some mistakes or potentially even opportunities that come from people trying to fit things into this program, which is sort of interesting. Just because, studio apartments in Calgary, I would never recommend, just from a sales and demand perspective, because as the rental market softens, those become the least desirable thing out there, right? So it is interesting to see what the long-term effects are going to be of these programs that kind of force certain types of development. That will be interesting to see how they withstand kind of long-term.
Yeah, it's a really good point. It's a really good point, Natasha.
Judy asked about interest. She said, can you talk about interest rate buy downs or how those work?
Yeah, that's a great question, Judy. So when it comes to interest rate buy downs, I'll say that, see if I can blank my screen. There we go. So I'll say interest rate buy downs are really, it's a really important point. In one of my earlier slides, I talked about debt service ratios and what that means. And so when it comes to interest rate buy downs, the way these debt service ratios are calculated is you look at the loan amount, the income from the property compared to the loan amount. And you take the loan amount and you take the amortization and you apply an interest rate to it to calculate what the mortgage payments would be. Then you compare the mortgage payments to the income from the property. Now, the key in that equation is interest rates, because when it comes to interest rates, you're sort of, when you're applying for this mortgage to CMHC, you're anticipating or you're expecting what an interest rate might be. And then as we've all seen in the last number of years, or if you follow interest rates or bonds closely, you'll see that interest rates have been very volatile in the last few years. They've really been swinging from one extreme to the other, and even in a space of a few weeks, a lot of volatility. We saw what happened with the election today, and bond yields took a bit of a jump, and that means interest rates are taking a bit of a jump as well. And so ultimately, what I'm getting at is that if you take this interest rate and you're applying to CMHC for it, CMHC is doing this calculation based on the interest rate you tell them. So you do that, they approve it, you get the approval from CMHC, and then what might happen is that interest rates might change. And if interest rates actually go above the interest rate that you calculated as part of your debt service ratio, then you're sort of offside from how CMHC derived the loan and how they calculated it. And what you have to do in that case is you have to do what's called an interest rate buy down. The other thing you can do is you can reduce the loan amount to allow you to hit that interest rate level as well, or sort to hit that debt service ratio. Typically, buy downs mean there's less. It's less penalizing to the borrower if you do an interest rate buy down, which is basically a calculation to the lender to say, hey, the actual interest rate is X, but CMHC's maximum interest rate is Y, and there's a gap. And so if the lender actually has to give you that lower interest rate, they're going to be taking a loss over the course of the 5 or 10-year period for that. And so what they do is they do a present value calculation of the future stream of income for each year. They present value it to today's dollars, and so it's a bit of a discount. And they say, well, if you pay us this amount, it'll compensate us for the losses in reducing your interest rate below what the market interest rate is, and then we can give you that lower than market interest rate. And so that's what interest rate buy downs mean. So when you're working with a lender or a broker or whoever it is, and you're looking at what your loan amount might be, it's so important to pay attention to the interest rates. And the way we really stress this with our clients is, we show them scenarios to say, hey, if interest rates go up or they go down, here's the impact to you in terms of your loan amount or in terms of what a buy down might be. So it's a really good question, Judy. It's a very topical and timely question too. But the interest rates that you use in this calculation is key. And if they go up higher than expected, it impacts your loan amount because of how important that the debt service ratio is. I hope that helped, Judy.
Just to add something to there, what's so different between this and say a residential mortgage is like you get your approval, you sign on the dotted line, and you wait for closing. And that's a very different thing than this process when there really is several variables that could have a financial impact on you before closing that no one can promise you or guarantee you those things, right? That's very different than the residential world. So thanks for clarifying that. It's something that I think is not quite understood out there often.
Yeah, and I'll tag on to that as
Yeah.
well, and I'll say, like, in the residential world, you have mortgage pre-approvals. You go to a bank or a
Yeah.
mortgage lender, and they'll give you mortgage pre-approval. Here's what I can qualify for. You're good. When it comes to CMHC mortgage, you don't actually have that pre-approval until you apply to CMHC and get that, and that could be a 2 or 3 month process. There was times when that process was a 6 month process, and then when you're in the market, sellers don't love waiting for 2, 3, 6 months to wait for your approval before going firm on a property. Or in the case they're building it, they don't love that either because they're going to start building and they don't know if you're actually going to come through. And so often borrowers are having to make decisions, and informed and educated decisions, aware of all the risks, to say, okay, if I go firm on this property, you make sure you talk to a good broker, a good advisor that tells you kind of where you are today, what are some of the range of risks that you might face, and are you comfortable with that in going firm on something that you're not going to have assurance on for a number of months. Or you can convince your vendor to give you the time to do that, or you can partner with or invest with somebody that has some deeper pockets and maybe allow you to hedge your risks. But it's a very different world, and it's really important to get good advice there.
Yeah, very different world for sure. There was one more question here. Go back to the top. Oh, Craig had an interesting question. He said, if I buy a home that I'm going to demo to develop row houses and that house had a tenant in it, will CMHC consider your development existing property instead of new construction? I've been told that there has to be 12 months since the house that was knocked over had a tenant.
Yeah, so great question. So if you buy a home, let me read it again. So if you buy a home that I'm going to demo and develop row houses, house with a tenant in it, will CMHC consider development existing property instead of new construction? I've been told 12 months. So look, I mean, so the couple of things here that I'll mention. I mean, like one of them is, like, one of the requirements CMHC has if you're doing a new construction. This is a policy of all the things that have changed. This is the one that makes me scratch my head the most. Is that when you're doing a new build, CMHC actually wants you to demolish the property that's existing before you apply to CMHC for a new construction project. And this is problematic because you're having to, get rid of a tenant, spend money on demolition without assurance that you're actually going to get approved for the new project. And it also means you're destroying rental housing before you have comfort or approval that new rental housing is going to be approved. So it's problematic. Now, if you're once you tear that house down and you're applying to CMHC for construction financing, it's considered new construction. CMHC had some confusion around that a number of months ago, and they finally cleared that confusion around if the property is no longer there, it's demolished, it's considered new construction. But the demolition piece is really important and really interesting. It's actually turned some people off and away from doing construction projects that would have added much needed supply to the market. But it's a really interesting, policy that they've come up with. But short answer to your question, it's considered a new development once the property is demolished.
Okay. I guess that sort of answers Morgan's question as well in terms of timeline. Okay, that's great. Judy asks about, she said, going back to the rate buy down thing, which again, this is the problem, is like how much time in between these things. But when you have a 1.10 debt coverage ratio, how likely is it that an interest rate buy down would be required?
Yeah, it's a really good question. And frankly, it really varies by project, by location. There's so many variables. I mean, what I would say is that the really important thing to do is when you're looking at the loan you can qualify for, is look at like what is the interest rates that's being used for that qualification. Is that interest rate reasonable for today's market? And I really actually want to make a point, Natasha, which is that a lot of people that I talk to say, hey, I read in the newspapers, I hear everywhere that interest rates are coming down. So why can't I just expect that rates are going to come down? And I've been saying this for many months when everybody in the market was like, interest rates are going to come down. I really like to differentiate between construction and bridge loans, which are interest rates are floating over prime, and prime is impacted by the Bank of Canada reducing their overnight rate. So when you have those kind of rates that are floating over prime, then yes, the Bank of Canada is expected to lower their rates, and the prime rate will likely go down, and your interest rate will likely go down with it. But when you're doing a CMHC purchase or a term mortgage with a non-CMHC lender, like any type of commercial mortgage, they're typically fixed. Let me just keep it at CMHC. They're typically 5 or 10 year terms, and those 5 or 10 year terms are priced off of bond yields plus a spread. And I was actually talking about earlier, like the Bank of Canada reduced their interest rate by 50 basis points a few weeks ago, and you know what happened in the bond market? The bond market actually came up. So while prime rate came down, bond yields actually started going up. And then you take an event like the US election and Trump wins and there's expectations with what's going to happen with stocks and bonds, and bond yields go up even more. So it's so important to say, like, I really want to stress this is, if anyone is telling you that interest rates are guaranteed to go down and you'll be fine, I really want all of us to be thinking about adding a buffer to the interest rates that you're looking at. So like if someone shows you, your debt service ratio of 1.1 means you can get 80, 85, 90, 95, whatever that leverage is, look at that interest rate and add a buffer to it and ask yourself or ask the person you're working with, what happens if the fixed interest rates go up a little? What is my exposure and will that come down? And that will really address your question, Judy, which is such an important question, such a good question, which is, you can get a 1.1 debt service ratio and really be comfortable and have a ton of buffer in your interest rate, but it might mean that your loan amount that you're banking on is 80 or 85 or 90% loan to cost instead of 95. The thing I would say as well, Judy, and everybody else, is that the leverage that you get is really, it varies by region. It varies by how well you buy property. I pick in Alberta because I know WealthShare is headquartered there, but cap rates in Calgary and Edmonton are a certain level. If you go to Vancouver and Toronto, those cap rates are much lower. And what that tends to mean is you're paying a lot higher multiple for every dollar of income is what you're paying on the purchase price. And what that then means is that the leverage you can typically get in those markets is much lower than what you can get in markets with higher cap rates. We've done some loans in New Brunswick as an example, and the cap rates are higher there than they are in Alberta. And guess what? People tend to get really high leverage there because the properties aren't as expensive relative to income. And so the answer to your question really is in the details, but it's really about looking at the interest rate relative to the leverage you're getting and making sure that it's reasonable at the debt service ratio you're calculating. I hope that helps.
It's such a complicated part of this business. And the summary of all of that, really what I have learned is always have extra capital available. That because there's just so many variables that can change over time, and we can do our best and work with the best professionals, but you cannot guarantee these things, especially when you have long timelines. It's very, very challenging. So yeah, really good question. Craig has a question he wants to ask. He's going to unmute himself because he said it's a little hard to type. So Craig, you're good to unmute. You're good to unmute if you want to fire away.
Thanks. Can you hear me?
Yes.
Okay, awesome. Thanks, Nadeem. So what I'm wondering is, how do I access my equity when I'm in an MLI Select after 5 years or something? If I want to get my partner's capital back to them, how do I go about that? Do I put a second on there at that point? Does that second have to re-qualify? Like, how does that all play out?
Yeah, such a good question. And it's such an important one too. So look, there's a few things I'll say. Typically a CMHC term mortgage is a minimum of a 5 or 10-year term. But let's say you choose a 5-year term or a 10-year term, within that time frame, let's say you choose a 5-year term and 2 years later, rents have really jumped up and interest rates have come down, and like you bought the property really well and is valued more, and you want to pull some equity out. You actually do have the ability to get a CMHC MLI Select second mortgage that you can add to your property. You are paying premiums on the entire first and second mortgage balance, so you have to keep that in mind. But you are able to do that and pull some mortgage out. When you do a second mortgage, you're having to also, CMHC's stance is that if we're giving you more money, we want something in return in terms of social outcome. And so if you're doing, let's say, affordability, they want you to recommit to 10 years of affordability from that point. Or if you're doing energy efficiency, they want additional improvements in energy efficiency. But you can do a second mortgage within the term of that mortgage. Now, let's say you did affordability, Craig, and you did a 5-year term. At the end of the 5-year term, your 10-year obligation of affordability is still there, and you still have 5 years remaining on that affordability commitment of 10 years, even though you have a 5-year term. However, you have more flexibility there, and you can go back to CMHC and say, hey, you know what? I want to refinance the property. I'm still committed to the remaining 5 years that I agree to, but you know what? I'll give you an additional 5 years. So I'll commit to 10 years today, and it'll give you 5 more years of affordability. Will you refinance my mortgage? And CMHC will do that, and they have done that before. So keep that in mind, is like you are able to refinance. The obligation that you've committed to, especially if it comes to affordability, doesn't go away, but you do have the ability to refinance at that time. Does that help, Craig?
Yeah.
I'll take that as a yes.
Yep.
Yeah,
Awesome.
Thank you.
No problem.
That's great. Okay. I think we covered the questions. That's awesome.
Super. I think Anne had a question as well.
Well, maybe did it go to you direct?
Potentially. I'll read it out. The question is, say I purchased a new construction multifamily today and it will qualify under new construction policy with 25% of the units is affordable. But in 5 years of mortgage renewal, I will have to requalify under existing property. Correct? Yes. This will mean I'll have to designate a lot more units to be affordable. Is it correct? Great question. And absolutely the answer is yes. So what defines new construction from existing is that new construction is something it's been less than 12 months of stabilized income, meaning it generally building is fully leased up or close to fully leased up for less than 12 months. And it's been less than 24 months since the occupancy permit was received for the building. Both those things have to be true for it to be considered new construction. Of course, at the end of 5 years, if you bought a new building 5 years later, it's definitely going to be considered existing. And if you want to get another MLI Select mortgage at that time and qualify for points, absolutely, you'll have to designate more units as affordable, no question about it. So it's something to keep in mind if you're looking to refinance at that point, and it's a great question.
Really good.
Yeah, there's also, perhaps I can clarify, I realized Morvin's question really is, does full demo have to be complete before commencing an application, and how does an applicant show that it has been done? So the answer is yes. Actually, the way CMHC has been asking the question to us recently is, has the demolition been done? That includes the foundation and the footings. They really are asking specifically, has the demolition been done? At the moment, CMHC is asking for that, essentially via email communication, and then they're putting it on the lender to actually verify that that's done. So the lender will typically go to the site. They'll typically want to ensure that the demolition's been done, and so that's how that piece is managed. But yeah, hopefully that helps, Morgan.
That's great.
Yeah, I want to be mindful of time. Maybe what I'll do here is I want to talk a little bit about what changes are expected to come up with CMHC MLI Select, and I hinted at a few of them. One of them is I really want to. This is interesting, and not everybody in the market is aware of this, but yeah, a few months ago, CMHC announced, and they didn't make a whole big announcement about it. They just put it in their financial statement. So CMHC is a entity that traditionally pays dividends to the government of Canada. So they make money by way of premiums, they spend money by way of their overhead and by paying for claims and losses, and the difference is their profit. And they've typically been very profitable, especially in the multifamily side, and they've been paying dividends to the government of Canada. Last quarter, CMHC stopped paying dividends to the government of Canada. And they put that in their financial statements and their quarterly financials. And what they said is that there's a regulator, OSFI, the Office of Superintendents of Financial Institutions, that's taking a closer look at CMHC and starting to treat them the same way they're also starting to treat lenders in the market as well. And so what they said is that they're stopping the dividends to the government of Canada because OSFI is looking for them to pay to increase or to have higher capital reserves and capital requirements. So that's really interesting to see. And what that tells me is that CMHC likely doesn't have the level of reserves that OSFI wants them to have to cover any potential claims and losses. And what that in turn means is that CMHC, in my opinion, is going to get more conservative in the loans that they do. And frankly, we've seen that, especially when it comes to CMHC insured construction loans. Everybody was getting 95% leverage or close to it in whatever market in the country you're in. And we've started to see some applications get rejected by CMHC because it's a borrower that perhaps is doing their first project, even if they're hiring a super experienced construction manager, and if that project is in what's called an unsurveyed or rural market. So CMHC surveys a bunch of different markets across Canada, and they have average rents and vacancy data. If it's a market that's not surveyed or that's rural, and this happened in the few rejections that we had, which in my career have been very few and far between, and it's because CMHC just started to close the window of the appetite that they had and didn't really say anything to anybody, and they just started applying that to deals. So I would say that is one thing to really keep in mind is, you really want to consider partnering with people to build that bit of a buffer. To Natasha's earlier point, have more cash in reserve, or invest with groups, invest with people that have that ability to backstop or to qualify for these projects. So it also may mean that premiums may go up as well. If they don't have enough reserves, one other easy way to do that is just to increase premiums and start really accumulating those reserves. I also talked about affordability metrics, new median incomes being used, energy efficiency, the new building code. So affordability might get easier to qualify for, energy efficiency might get harder to qualify for. CMHC also has a direct lending program called the ACLP program. It used to be called the RCFI. And there's a lot of rumors out there that CMHC is looking to really revamp that program and make it easier to qualify for. So keep an eye on that. I want to be mindful, Natasha. I know you have some content as well. So
just to add a couple points to that too, loan to value does not necessarily mean loan to purchase price as well. That's a very common misconception out there. And all of these things and variables change potentially your loan amount. And so that's why it is challenging to go this alone. It is a huge bite when things swing or change or move around. So thanks for that. And yeah, sticking to kind of the smaller areas can be challenging. We've had a lot of interest in investors wanting to invest in those smaller markets, but that's always my fear too, is CMHC or lenders change policies and become more conservative, and the first thing to go is wherever has the least amount of data or smaller populations. So yeah, really, really good points. I appreciate that. Maybe I will kind of the last 10 minutes here speak a little bit about WealthShare and what's going on, but I think that was extremely valuable. How do people reach out to you and your team, Nadeem? Because I want to make sure people are going to you if they would like some support on this side. Nadeem's put his email in the
Yeah, I just tossed my email address in there. We have a website. There's a bunch of free tools and resources. Frankly, like, regardless of who you work with, and I really mean this, is I really want people to be educated. So we put a bunch of resources out there that are free on our website. We have a bunch of calculators. We have a bunch of videos on YouTube. I'll send you that link too. Use as much as you want. We'd love to talk to you if there's a fit, but no pressure. Just want to make sure everyone is as well supported as they can be in this industry.
It's okay. Well, we will leave it there. That was fantastic. Thank you so much for sharing. I'm going to speak a little bit at WealthShare. Nadeem, I understand if you have to run as well, but I thank you so much. I hope you guys found that valuable and informative, because I know I do. And like the thing about this space too is how rapidly it changes. Like what works and what we're talking about one week can be very different the next week. So yeah, that's the big thing about it too, is small changes. Well, as Nadeem said too, like there's no big announcement necessarily, right? Like it'll be a change and that's how it is now. And everyone just has to know that that's how it is. And that's the reality of when we have kind of one insurer in this space that is doing these types of things. So just make sure I didn't miss any comments or anything there. Okay. So very quickly, I won't go through the whole WealthShare sort of pitch. I think everybody here mostly knows who I am, but I am a investor first and foremost, like most of you here. And WealthShare was really put together to build something to create the types of opportunities that are accessible as a group in this multifamily space that many of us are interested in, but it's really challenging to go that alone. And so that was really kind of what got WealthShare started. And I'm going to share my slides here in a second, but really it was about creating accessibility into a space that is not very accessible. Not just the multifamily space, but large kind of like assets that many of us maybe dream about being a part of. That's really difficult to do on your own. And so we have three kind of like fundamental things at WealthShare that we want to really shine in our community. Number one, this is a very good example of this tonight, is sharing of information and knowledge. The world is only getting more and more accessible in this way, but I do still find in this space it can be a little bit like gatekeeping still. So we do not want to gatekeep in any way. We want to share everything we're learning along the way. And the people that we are working with that we know are doing an excellent job, we want to also share them as well. And so the education piece in the WealthShare community is a big one. And number two is that value of accessibility. So when WealthShare started, we had to make lots of decisions, but one of them that we spent a lot of time on was even our minimum investment. And what does that mean? And we set our minimum investment for WealthShare very low intentionally because we want people to get started. We know people who even want to own real estate in Canada. That's becoming more and more of a challenge. And so the accessibility piece is really, really important for us. So our minimum investment is only $5,000. And I can promise you we need, all of our size of investors. But what we have found is people are then investing, they're getting started, and that allows them to dip a toe and then to also learn and be exposed to things. So that's something we are also very passionate about, and sharing everything along the way. And then our values of transparency is also a really, really big one. So I'm just going to share my slides here quickly. So just to kind of put up our offering and who we are is what I'll focus on, and then tell you a bit about our strategy just in these last few minutes. So the WealthShare offering really quickly. The first line there is really, really important. This one is something I could talk about for an hour, and that is the terms eligible and accredited investors. And really what that speaks to is who we are open to as investors. And there's all kinds of private offerings out there that are only open to accredited investors. And this was something that was really, really important to us, is that we wanted to do everything we can in terms of structuring WealthShare, as well as the infrastructure we have in place to really speak to that accessibility. So if you're not sure what eligible and accredited investors mean, just give it a quick Google. But really, it has to do with the investor's income or net worth, or what they have. And then the framework in Canada, in terms of legislation, kind of decides which bucket an individual might be in. And then us, as the individuals raising money, or if you're raising money, you as well have to comply by the securities laws in Canada. And this is something that I don't think is spoke enough about, that is talked about enough, but this alone is really, really important. And we are open to eligible and accredited investors here at WealthShare. The second point is that we are open to registered funds as well. So you can use your registered funds to invest with us, and starting at $5,000 or more, you choose what kind of number fits. We have found people have a lot of different random numbers in their registered accounts that they don't know what to do with, or many other funds won't accept them because they're under their much higher threshold. And so we have kept that pretty broad and open. Our returns are a 12% targeted return. And what that means is every acquisition that we look at, we are aiming for a 12% annual return. Now, those returns are comprised of just the same things that you would have in your investment property, but at a larger scale. So we're talking about debt pay down, which is the most predictable sort of component of this, cash flow, and then also value add of the properties, which really in our case means doing a really good job managing these things. And then of course, general appreciation in the market. So all of those things combined is how we hit a targeted 12% return. Last year, we did an 11.1% return, and our audit that we're in right now will determine our return for this year, early next year. We're on a continuous raise as well. So I get asked this question a lot, like, when are you kind of done? Or when is this sort of like, when have you hit that milestone? And there is no, like, once we hit this number, we're done, because we're not developers, we're not builders, we're building a portfolio and doing the kind of boring thing in real estate. This is long-term buy and hold, maybe not as sexy, but more predictable, boring, long-term real estate. That's what we are doing with WealthShare. Right now, if we ever choose to get into a different strategy, we would open another fund. So we could, have many offerings in the future. But right now, this is all we are doing. And we wanted to do a really good job in the kind of most predictable way with real estate, and that is buy and hold real estate. Our current unit price is $11.10. And we came out of the gate last year with a $10 unit price. And so right now we're at $11.10. So what that means is if an investor that had invested with us at the beginning, they would have had an 11.1% return on their capital right now. I do want to point out a few things quickly that is a benefit to you as an investor with this structure, whether this is us or other REITs or funds out there. But what a REIT is just a vehicle that allows the operators to pool investors' money towards a common goal. So as you just heard Nadeem say, this commercial space comes with big opportunities, but also big challenges, and you may not want to necessarily go that alone. And so a fund like us allows you to invest in all kinds of different things, not just multifamily real estate. It could be development, it could be seniors. There's all kinds of different funds out there, but this is the vehicle that allows investors to do that. And as an investor, you purchase units, or most similar to like shares in a company, in the trust, and you get to benefit from what the entire portfolio does as a result. So this provides a direct sort of like opportunity into real estate without actually having to own the real estate or qualify for the financing or deal with any of the management. We take care of all of that for you, as well as invest in maybe opportunities or strategies you might not be able to do alone. Like, we can't all do it alone ourselves. So this is a great way to do that. These are my probably favorite benefits as an investor, and what we also love to share about WealthShare and what makes us different from maybe other private securities out there that might be more, peer-to-peer or joint ventures or something like that. So we are registered with the Canadian Securities Administrators. We are governed by securities laws in this country. And the third point on this might be the most important. And we are subject to not just all of the legislation and compliance that the Canadian Securities requires, but third, also, we are required to do an annual financial audit. And I did not entirely know how in-depth and detailed this is before we went down the WealthShare road, but I can promise you it is to the penny, to the dollar. Every bank fee, every charge you can think of has to be backed up and proved. So as an investor with us, when you see your financials, an independent party has reviewed every single transaction to ensure that there is a full level of transparency here. And the reason I'm shining such a light on this is because I know there has been a lot of challenges in the marketplace this year. There's been a lot of volatility in this space. And most of that volatility and sort of bad news was structures and scenarios that were not going to this level of due diligence or auditing, or even honestly paying attention to what the Canadian securities laws should require. And so it's really important to understand that we take that extremely seriously and are required to maintain everything that we have going on. So quick advantages, which we talked about: you can use registered funds to invest because we are a compliant place to take registered funds deemed by the CRA here in Canada. We are a team that will professionally manage your portfolio for you. And this allows you, like I said, to obtain strategies that you might not be able to do on your own. And that could mean also different geographic areas in this country as well. So what is our strategy? It's pretty simple. We are buying good assets in good areas and doing a hell of a job managing them. And that is really, really fundamental in the multifamily space. A large portion of your valuation on an appraisal is really a direct result of how well you manage it. The income that you take in, the expenses that you have, all will result in a net operating income for your property, which then in combination with, the entire report though, and the cap rate do determine the value of your property. And so if you are doing a poor job managing your property, or doing a poor job managing expenses and income, your valuation will go down as well. It's one of the things I love about multifamily real estate, but it also is something to be aware of when you're investing with people. Do they have the experience that is required for this space? Are they licensed and experienced? And are they doing the right things in terms of taking care of your hard-earned money that's going to work in these assets? So these are just a quick few photos of the assets that we've acquired. This is what we acquired most recently in Edmonton. This is 16 freehold townhouses in Southwest Edmonton, but you can kind of get a sense of the real estate that we like. We like new or new-ish, and we bought well on all three of these acquisitions. Our goal is to do, one acquisition a year is at a minimum, and the first three projects, here are some photos of them that we have done. And so this is in line with what we are looking at. Where we are going next is a direct kind of response to the investment that we will get in following the end of this year and into next year. But there is two big opportunities ahead of us that we are very excited about. So if you do consider investing with us, this is where your money will go. There is a couple larger opportunities that we are looking at in the kind of $10 to $20 million mark in Calgary and Edmonton, but very much in line with what we have already acquired: new or new-ish properties that are predictable and will be making money from day one, and taking advantage of all the things Nadeem talked about, because there is so much strategy when it comes to the financing, when it comes to how well these properties will not just perform, but how well they will provide you returns. So that is where capital coming in is going. and we have some great opportunities. So if you're not familiar with me, I am a licensed commercial realtor in Alberta and have been doing so for the last 17 years and have a very good pulse on what is happening in the market. I have access to excellent opportunities, and that's already paid off for WealthShare and will continue to. So that's kind of where we're going next. I did want to tie in a couple key points that Nadeem had mentioned when you're like thinking about where to invest your money and some key questions to ask. I did also even write a guide of some questions to ask, but it's important to know that we care a great deal about how well these properties perform. We have personally guaranteed all of the debt on the portfolio, but our investors are the owners. So our investors are the owners, but we have taken on that guarantor role to make sure that we get good financing, and are here to kind of, take care of this portfolio as a result, not just for our own investment, but also obviously to take care of yours. So that hopefully should give you some comfort to know that our investors are the beneficial owners, and we have personally guaranteed all the debt on the portfolio. So that is everything. If you are interested in reviewing the WealthShare offering more, two things. We did just a couple weeks ago a full 1 hour webinar about WealthShare and the opportunity. I've already had a couple people ask for it this evening. And so maybe as a follow-up to tonight, we will send that recording where I dive much deeper into all of these details. But we are essentially a way to invest with us passively into the multifamily asset class. You will learn by being in our community as well. And you may learn you want to go it on your own as well, or maybe you learn that you don't, because there is a lot of variables. I'm a big believer in sharing what we are learning on the way, the good, the bad, the ugly, and I hope that you will find that with us as you continue with us. If you want to review our offering, we'll put a link. Maybe Rodney or Crystal could put a link in the chat to our actual offering, where you can review the financials, the actual documents, everything that you would need to know to make a good decision about WealthShare. The one thing I wanted to highlight before I let you guys go is just the offering details here and what these mean. We are the issuer, so we are raising capital to buy these assets. And as a result, as I just said, I don't own these properties. Our investors own these properties. So how do we get paid? We're obviously investing in WealthShare as well, but the issuer fees, I always like to note what this is because it's a bit misleading. These are not fees like you would get at the bank. These are fees that we have to disclose and want to disclose as to how we sort of keep the lights on here, what's in it for us to manage these properties and also grow the actual portfolio. So the fees that we get help us keep the lights on, help us manage things. So, but are not a deduction from your investment. They're an operating fee of the actual real estate investment trust. So we have acquisition fees, financing fees, and management fees. But what's really in it for us long run is the performance bonus. So you might have saw earlier that there was an 8% preferred return to our investors. What that means in very simple terms is that if we do not hit an 8% preferred return to our investors, us as the management team do not take part in any returns for the trust that year. So you can feel confident that we are working very hard to do everything we can to hit the returns that we want to hit, because in the long run, this truly is what's in it for us. And the smaller sort of ongoing fees are what help us kind of keep the lights on as we do acquire and manage the fund as it grows. But bear in mind, your investment, these are not deductions from your investment or costs to invest. There is no fees to invest with us. They are more management fees to keep things running. And then dealer fees that you will see, those are fees that the trust may encounter to raise capital out in the capital raising world. Typically, we are not going up to 6%. Typically, we're in the 1 to 3% when all things are considered. And where those fees go and why they are required is we do have an exempt market dealer called Atlas One. The link that was hopefully put in the chat is to our offering, and you will see that it is housed on the Atlas One platform. This is a requirement to use an exempt market dealer. for the reason that we are open to non-accredited investors or eligible investors in this country. If you want to raise money by way of offering memorandum, which we are, you are required to use an exempt market dealer. So they're there to ensure suitability for the investor, to ensure that we're compliant, and all kinds of very important things that ultimately protect you as the investor. So when you go to the platform, that's why we are there. And they're also a very cool platform that there's a lot to see and check out there. So I encourage you to go make an Atlas One account. You'll just need to enter your name and email, and you can view our offering there, as well as all kinds of other really interesting things on their platform. So I will leave it there. I hope we didn't go, how bad did we go? We're 8 minutes over. That's not too bad. But if you would like to get the guide that I wrote for passive investing, this is a QR code. If you want to scan that with your phone, or we can email it as well. And this guide is really to share everything that I've learned along the way in the last 3 years, starting WealthShare, that I would not have known to ask about or inquired about, before my experience here, that will help you analyze all kinds of opportunities out there in this private security sort of space. I'm very confident most investors in our world know how to analyze real estate. They know how to analyze rental income and expenses, but I find it's not discussed enough of how to analyze these passive type of securities. So I hope that is a little bit helpful. Feel free to scan that. And if you do want to learn more about WealthShare, please connect, and we'll set a call and connect with you one-on-one and get all of your questions answered. Let me see. Oh yeah, Rodney did put a link in the chat. Awesome. Thank you, Rodney. Yes. So that was everything I had. I kind of whipped through it. Hopefully that was helpful tonight. Nadeem is an awesome speaker. He is so full of knowledge. And please reach out to Nadeem and his team if you need help in this acquisition sort of space. They are an awesome group that will support you on your real estate investing journey. And if you have any questions, please let us know and reach out anytime. We're here to help you guys. And I thank everybody for your time being here with us this evening.